By the end of this lesson, you're going to understand exactly when and where to enter the market. But here's something even more important to remember. Learning not to be in the market is also a position on its own. That constant urge to always jump into trades? Yeah, that's a problem most traders suffer from. It's that impulsive nature. And don't worry, we're going to fix that. Let's dive into the entry model. All right, the model I'm talking about is the PSE model. This is a new concept introduced in the Falcon trading strategy, and trust me, it's going to be vital when it comes to understanding entry types, especially if you want precision and confidence in your execution. But before we even touch the actual entries, you need to understand why this model is so important. Because listen, most traders jump straight to entries without even asking where the market is or what kind of movement it's showing. That's like trying to shoot without aiming. Doesn't work, right? So what does PSE stand for? P is for positioning, where we are in the market overall. S is for sequence, how price is behaving or unfolding. And E is for entry, the final piece of the puzzle, and it only makes sense once the first two are clear. So the position of the market and the sequence it's forming will directly impact how and when you should be entering. Get the first two wrong? Doesn't matter how perfect your entry is, it'll likely fail. Understanding the PSE model will not only sharpen your entries, but it'll also help you avoid those unnecessary, emotional trades. Let's take a look at the positioning here on the left. This red line at the top, that's our area of value. It's the key zone where we expect high probability trades to form. Now, when we look at this first example, notice something important. The market has left a huge gap between price and the value area. That distance is a red flag. Why? Because it tells us the market isn't currently positioned well for an entry. We're too far from where the best risk-to-reward setups usually form. Now, the sequence in this case looks fine. It's giving us some structure to work with. But without price tapping into the value area, the entry wouldn't have the full weight of confluence behind it. What we really want to see is the market pulling back into that red line, our area of value. That way, we know we're positioned correctly to take advantage of this potential downward movement. Remember, no position equals no trade. The best entries come from the best positions. All right, so we've covered positioning. Now it's time to break down the sequence. Take a look at the first example on the right-hand side. At first glance, the obvious question would be, why is this marked incorrect if price has clearly tapped into our value area? And that's a fair question. Yes, the market has closed the gap, and it's touched our area of value. Great. But here's where the problem lies, the structure itself. What we're seeing here is a big consolidation zone. Price is just moving sideways. This isn't the kind of healthy structure we want to see if we're looking to continue selling to the downside. Instead, we want to see cleaner, smaller corrections leading up to a bigger one. That's our ideal sequence. Think of it like a staircase. Step-by-step pullbacks showing momentum, not a flat platform where nothing's happening. That's our typical sequence, and that's the confirmation we're looking for. But here's the thing. Just because the sequence doesn't start off perfectly doesn't mean the setup is completely invalid. It just means we might need to adjust our expectations or take different measures. Whether that's waiting for more clarity, using a different entry type, or managing risk more tightly. Now it's time for us to dive into the entry types. In this video, we're going to focus on just one method, the classic 3-touch example. So, up here at the top, we have what's called a risk entry. In this case, we're dealing with a bearish continuation pattern. A risk entry is when you take the trade within the structure itself, before the breakout. Looking at this structure, we can clearly see touch 1, touch 2, and touch 3. The entry is placed on the close of the rejection candle that forms after the third touch. You're anticipating the market to continue down from within the pattern, without waiting for a breakout. Now down here, we have what's called a reduced risk entry. This is where the entry order is placed after the structure has broken. You're basically waiting for confirmation, letting the market show its hand first. Pretty simple and straightforward, right? So let's line them up. First, we've got our risk entry, and second, we've got our reduced risk entry. Both are valid. It just depends on the position, the sequence, and your confidence in the setup. All right, Now let's move on to some real chart examples to bring everything together. On the screen, we're looking at gold on the 4-hour time frame. It's super important to always start with the bigger picture. That's why using multiple time frames is key. So from here, we're going to backtest a section of the chart, starting from this point, and see how well the PSE model performs in real time. Remember the model: position, sequence, entry. So first, we're looking for our area of value. This tells us if we're positioned correctly. And right here, we can see that area clearly, thanks to the volume and price activity created at this level in the past. Now, the 4-hour gives us the overview, but to pinpoint our touches more precisely, let's scale down to the 1-hour time frame. On the 1-hour chart, we now get a clearer view of structure. Here at the top, we've got our first touch. Down here, the second touch. And finally, here's the third touch. This is the classic 3-touch structure we want to see before entering a trade. From this point, we have two options. Risk entry: entering within the pattern after spotting a clean rejection candle on the third touch. Or we can play it safe with a reduced risk entry. Entering after the breakout is confirmed to the upside. And as you can see, this setup played out beautifully, smashing both take profits. This is one of the simplest entry models out there. But don't be fooled, there's a lot more going on than meets the eye. When used properly with the PSE model, it becomes a powerful tool for high-probability trading. So, up here, we've got what we call a 2-touch continuation. Now, yes, you can enter a reduced risk entry after the break. But this is more advanced, so we're not going to dive deep into that in this video. What we will focus on is the positioning. We can clearly see volume building up in this region, which gives us a good reason to mark this as our area of value, meaning we're positioned correctly. Now, when we check price action on the 1-hour time frame, it doesn't give us clear points to work with. So let's shift down to the 15-minute time frame to get a better view. On the 15-minute, we can now easily connect the dots. We've got all 3 touches lining up perfectly. At this point, we can go for a risk entry right after the third touch. Or, especially if you're a beginner, you can wait for the breakout and take the reduced risk entry, which is often safer. But here's the key part. This isn't just about 3 touches. You need to start thinking in terms of liquidity points. Look closely. This low was taken out by the next lower low. That second low was then taken out by an even lower low. And finally, this last low took out liquidity resting right at our area of value. Do you see the pattern? Each leg is hunting liquidity before making the move. And that gives us deeper confirmation of intent. Hope that makes sense. Now finally, price has created this new high right here. Let's switch back to the 4-hour time frame to get an overall view of the market. Let's also remove all previous analysis, so we have a cleaner chart to work with. From the beginning, we can clearly spot our 3 touches. But hold on, the big question is, are we positioned well? Where exactly is our area of value? Perfect, we've got this low right here, which acts as our value area. That means we're in a strong position to take action. So from here, we could go for a risk entry around this area. Or wait for a confirmed break and enter with a reduced risk entry just after. Now let's talk target. From a longer-term perspective, our target is actually this high up here. So based on the structure and the higher time frame bias, price is likely to continue pushing upward to reach that high. But of course, keep in mind, we're looking at a 4-hour chart, so it's not going to happen overnight. Be patient. Now let's scale down to the 1-hour time frame again and take a look at the current price action on gold. At first glance, we can clearly spot our 3 touches. And over here on the left side, we see volume building up, which gives us our area of value. Right here, this is definitely our first opportunity for a risk entry. And for a reduced risk entry, we'll need to wait for a clean break above the structure. We also want to see momentum to the upside before pulling the trigger. But now, looking closely at this current structure, I'm not really happy with how it's forming. This right here is showing signs of a bearish continuation. And although we're looking for buys, this pattern tells us that price wants to push down first. So in this case, it's smarter to hold back and go for a reduced risk entry, just for better confirmation and to stay on the safe side. And that wraps up this breakdown, traders. You've now got a clear understanding of the PSE model, position, sequence, and entry, and how to use it to build high-probability setups using real chart examples. Remember, patience and precision will always beat impulsiveness in the long run. If this lesson brought you value, don't forget to like the video. Drop a comment if you've got questions, and subscribe for more breakdowns just like this one. Catch you in the next video. And until then, trade smart, stay sharp, and keep evolving. Peace out.